Hi everyone, good morning. My name is Deepak Bisht and we are discussing the merger and acquisition series, advanced questions. So today we will try to complete this series. Uh, let's start with question number 19 onwards. So question number 19 is about what are the three main transaction structures you could use to acquire another company? The three main transaction structures you could use to acquire another company, and we have previously discussed about the stock purchases, asset purchases, and 338 H10 elections and their basic differences. But let's discuss everything here in detail today. So, stock purchases is actually, and okay, before that, let's understand what the question is about. So, when one company wants to buy another company, there are few different types of legal structures few legal structures that can form the deals, and each has different tax and accounting consequences. So if you are taking stock purchases, if you are taking the deal of asset purchases, or if you are taking the deal of 338H10, so the difference is in between tax and accounting. So let's start with stock purchases. So in a stock purchase deal, what happens is that the buyer purchases the stocks of the company directly from the owner, which are the shareholders. And this means that the buyer now owns the entire company in a stock purchase deal. If you are purchasing all the stocks and taking all the ownership, this means that all its assets, factories, cash, patents, etc., are yours, but all its liabilities also, debt, lawsuit, and other contractual obligations also, that also goes to the buyer. So the company itself does not change, only who owns it, that only changes. So imagine you are buying a car. So in stock purchases, you are not just getting the car, so you are taking over everything that comes with it, including the car loan, insurance, and any parking tickets along with this. So this is a stock purchase. This is the stock purchase deal. So the tax impact here is that the seller actually pays the tax on the gain from selling their shares, like selling stock on the stock market. So that's usually taxed at a capital gain tax rate, which is lower than ordinary income tax. And the buyer doesn't get to revalue the company's assets for tax purposes. So if the company owns a building that's worth more than That's actually if the company owns a building which is now worth more than what it was at when the it was bought up. So the buyer cannot start depreciating it again. This means few tax deductions going forward when a stock purchase deal is done. And because of that, an accounting concept called deferred tax liability is created. So that would be a liability. And it's basically the future tax bill the buyer is expected to pay. So this kind of deal structure is used when you are buying a public company or a large private company where it's easier to buy shares than to separate assets and liabilities. So this kind of deal is majorly seen in public companies when a public company is being bought up. I hope this makes sense to you guys. Stock purchases and the tax and the accounting consequences and the uh, treatments. Now let's move to the asset purchases part. So one was stock purchases, the another is asset purchases. So what happens in this kind of a deal is that the buyer picks and chooses which specific asset it actually wants to buy, like equipments, buildings, brand names, and which liabilities it's willing to take on, like specific debts or contracts, and the rest stays with the seller. So that's an asset purchase deal. And the and to understand this and look at it from a perspective, like it's like going into a bakery that that's closing down and just buying the ovens, the recipe, and the brand name, but not taking over the old lease or the bakery's debt. So it's an asset purchase deal. And the tax impact here is like the seller pays tax on any gain from from selling its asset. For example, it if it sells a piece of equipment for more than it was originally paid for, then the seller will actually have to pay the tax on that. And then when it distributes the sale proceedings to its shareholders, those shareholders can also pay capital gain taxes. So there is often double accounting, double taxation of asset purchases. So if I have already paid the taxes and my shareholders, who are actually also the owners of the company, if they are also paying the taxes, this means that there was a double taxation. And that's first of the tax impact. And the second tax impact is that the buyer, however, gets a big benefit. They get to step up also the value of the asset to the new purchase prices. This means they can depreciate or amortize the asset for I mean from this new higher value, which actually reduces the future prices, future taxes. So in this case, no deferred tax liability is created because tax values and accounting values actually match. So from a seller's perspective, double taxation is a drawback, but from a seller buyer's perspective, they get to step up in tax biases and allowing future depreciation and amortization deductions. But it does not create a tax liability. It actually creates a tax asset. So this is pretty much about deferred. This is pretty much about asset purchases. So this is used when a private company is being bought. So parts of business is actually bought up, or when a distressed company is being bought up. So where the buyer doesn't want to take on hidden debt or risk. So, or in cases of divestitures. So this kind of approach is followed in the asset purchases approach. So next, we will be discussing about section 3. So let's discuss about section 388 now. So, okay, so when the deal structure is about section 338 election, so this is actually a hybrid structure and it legally treats actually legally treated as a stock purchase, but for tax purposes, it's treated as if the buyer bought the company's assets. So this is actually it will be treated as a stock purchase, but for the taxation purpose, it will be treated as asset purchase. So analogy here to understand is that imagine you're buying a company by buying all its shares. So you legally own it, but the tax authorities let you pretend you bought all its assets separately so you can get a better taxation treatment. So the tax impact here would be that the seller pays taxes as if it is sold. I mean, as if it has sold all its assets. So the seller will pay taxes as if he has sold all its assets, and the buyer will get a step up in the tax evaluations or the asset values and can depreciate or amortize them, meaning they get future tax savings. So no deferred tax liability is created here, but only a deferred tax asset. And because it is more favorable for the buyer usually agrees to pay a higher price to the seller. So this is actually more favorable. And if you see, because using section 338, it is actually more favorable to the buyer. So buyer actually pays more if there is a uh, section 338 election. And this is used when private companies, subsidiaries, or divisions are being sold off, basically. So, quick comparison. Let's do a quick comparison. See, understand this thing. Uh, in a stock purchase, a company shares are being bought, and the buyer takes all the liabilities. The seller taxation. So seller will pay taxes on the capital gains on the shares, and the buyer doesn't get the tax benefit. Yes, it creates a deferred tax liability, and this is used in public or large companies. And under an asset purchase, specific assets and liabilities are being bought. Buyer doesn't takes the liabilities, but only the assets, and seller actually pays taxes on the assets and the capital gains here in the asset purchases. And yes, the buyer gets a tax benefit because the government allows them to step up the tax basis. So it will allow them to depreciate and amortize the deductions in future. And this is pretty much done in private or distressed companies or divestitures during divestitures. And asset purchases, by the name itself, defines that only the assets are being purchased. So if I'm only paying the assets, I am paying only for the assets. So this means that I will be only liable. I will be only liable for the responsibilities or the money I actually have to pay for the assets only. And the money I'm paying for the assets and the capital gains on the assets, that's seller's headache now to pay taxes on that, not the buyers. And the buyer can step up means that the buyer can uh, revalue the assets on the fair market price. And if the price, if he is stepping up, so the future depreciation and amortization deductions will increase. So this will give them a deferred tax asset in the future. And now let's discuss briefly about now let's briefly discuss about section 338 H subsection H and clause 10. So here the company shares are being bought, but this will be taxed like an asset because see, here buyer takes all the liabilities. Yes, the buyer does take all the liabilities. Seller actually have to pay taxes on the asset and the capital gains. The buyer gets a benefit of step up, and no deferred tax liability is created. Deferred tax asset is created, and this is favorable in private companies or subsidiaries or divestitures. Sorry, not just divestitures and subsidiaries. And this is actually more favorable to the buyer. So buyer at times are willing to pay more if there is a section 338 H10 election during the deal. So simply stock purchase is actually simple for buyer and seller, but worse for buyer's taxes. If you're buying, so it will be bad for you to have a stock purchase deal. For asset purchase deal, it's complex, but better tax benefits for buyer during an asset purchase deal. And in the middle ground, it's structured like a stock purchase, but the buyer gets the tax advantage of asset purchases. So that's why they favor this thing. This is section 388, subsection H, and clause number 10, election. I hope this is, even if you are getting a little bit of what we are discussing, it's okay. In future readings, I'll try to make it much more easier to understand. And let's move to question number 20 now. So question number 20 is about, would a seller prefer a stock purchase or an asset purchase? And what about the buyer? So we just discussed about the three types of deals, and let's discuss it one more time. So first, the two deal types are stock purchases and asset purchases. So buyer buys the share of the company in a stock purchase deal, and the buyer takes over everything, asset, debt, contracts, potential lawsuits, and all. And also, the seller gets paid for the shares and walks away clean. And during an asset purchase deal, so the buyer picks and chooses specific assets and certain liabilities. The rest may stay with the seller, and the seller keeps whatever was not sold, including some debt and possible taxes. So whatever the buyer doesn't buy, so it's actually with the seller only. And from the seller's perspective, if you think about it, almost the seller almost always prefer a stock purchase deal, and here's why: because in simpler and cleaner, it's a simple and cleaner exit. There are better taxation. The tax treatment is better for a stock purchase deal to the seller. Uh, so if I mean, simple and cleaner exit mean in a stock purchase deal, the seller sells all the shares, meaning they transfer everything. So the assets as well as the liabilities. And better for taxation means that when selling stock, the seller usually pays capital gain taxes only once on the profit they made from selling the shares. And in an asset sale, the company first pays taxes on the gains from selling his assets, and then the shareholders may have to pay another round of taxes. And when they are receiving the money, so a seller will, if a seller is, if I mean, if there is an asset purchase, so seller will not. Only okay. So sellers prefer a stock purchase. That's why, because it so because of the double taxation, that's a downside. So seller do not prefer asset purchases. So they prefer stock purchases bad because that doesn't include, or that actually takes care of the double taxation part. So imagine that you are selling a bakery. If you're selling the whole bakery, you pay taxes one time on the total profit. If you sell each part like oven, fridge, and recipe separately, so you pay taxes on each sale. And again, when you collect the total money, so that's not favorable for the seller because of the taxation, and because it's simple and cleaner. It's a simple and cleaner exit for a seller. And if you think from a buyer's perspective, so buyer almost always prefer an asset purchase deal, and because in an asset purchase, the buyer can choose what to take and what to leave behind in an asset purchase deal. And they might take the valuable stuff only, but avoid risky or unwanted things like lawsuits, old contracts, and debt. But in a stock purchase deal, everything goes to the buyer only. So in an asset purchase, the seller can select what they actually want to have. So and it's actually better. There are better taxation benefits to the buyer. So when the buyer buys the asset, they get to record them as a new purchase price, knowing as a step up in tax basis. And this means then they can depreciate or amortize those assets, which reduce their future taxes. And in a stock purchase deal, they don't get this benefit. So they cannot step up the tax basis. So that's why a buyer will always prefer a asset purchase deal. So because of the step up in the tax basis, understand this thing. So this means that they can depreciate or amortize those assets, which can reduce their future taxes. And in a stock purchase deal, they do not get this defect or this benefit. So they have to keep up using the old lower value of the assets on for tax purposes. And imagine buying a factory for $10 million. That originally cost a $2 million. And in an asset purchase, you can now start depreciating it based on a $10 million, and this will be a big tax saving. So the buyer prefers asset purchases, and the seller prefers stock purchases. So that's the crux of the whole question in this diagram. You remember this diagram and the theory behind it, the reason, the logic behind it, and that will be pretty much it. And hopefully you won't forget it. Um, So I hope this was clear. Now let's move to question number 21 now. So question number 21 is about explain what a contribution analysis is and why we might look at it in a merger model. So a merger model is just a financial analysis used to see what happens when two companies combine. For example, how much the new company will be worth, who will own what percentage of it, and whether the deal will make the combined company more profitable or not. So when two companies are merging, especially when they are roughly of the same size, people want to make sure that the ownership split. is fair. And that's why contribution analysis comes in. So what is actually a contribution analysis? So contribution analysis compares how much each company is bringing to the merger, revenue or EBITDA, pre-tax income, cash on hand assets, something, uh, sometimes even employees or market share also. So it's kind of like asking how much value is a company adding to its new combined business. And once you know that, you can estimate what share of the new company each side should own. And simple analogy is that imagine you and your friend decide to open up a new bakery together. A lot of bakery examples because that's what I'm getting now. Only that's what I'm able to think today. So you both agree to merge your existing bakeries into one big shop. You currently are making 100,000 per year in sales, and your friend is making 50,000 per year in sales. So together, the new bakery will make 150,000 per year. So if you both agree to split the ownership 50-50, that might not be a fair deal because you are bringing two-thirds of the revenue, and a contribution analysis would show that you are contributing, more or 66% of the revenue, and if your friend is contributing a 34% of the revenue. And it's actually used in real mergers. So if the ownership is, I mean, it's useful because to check the fairness and to understand the deal dynamics and also to negotiate better. So if both companies are merging as equal, so contribution analysis helps to ensure that the ownership percentage are reasonable based on what each side is adding. To understand the deal dynamics means that if one company is much larger, then the ownership split might not matter as much. The big company will naturally own most of the new entity. So contribution analysis is most useful in mergers of equal situations. And, uh, mergers of equal situations, yes, because when both companies are of similar size and power, merger or equal does make sense. So deal dynamics, this actually helps us to understand the deal dynamics also. And to negotiate better, if the smaller company thinks it's bringing something special, like a valuable brand technology or growth potential, it can use its analysis to justify getting a bigger share than its number alone, uh, which might suggest. So, if we summarize this thing in definition, comparison of what each company contributes is known as contribution analysis. And purpose is that it helps to estimate fair ownership split after merger. Okay. And most often it's used in merger of equal or less in large acquisitions. It's used less in large acquisitions actually. It's important to ensure fairness. It supports negotiation and shows how much value each party is bringing. And in simple words, if you are a bakery, if you're baking a cake, uh, what's bringing how much, who is actually bringing how much flour, how much sugar and eggs, and therefore who should get how much bigger slice. That's it, pretty much, contribution analysis. So I hope this makes sense, and let's move to question number 22. I think this is the last question of the reading, and let's wrap it up quickly so that we could complete this merger and acquisition series advanced questions, and afterwards we would start with the leverage and buyout series. Then we actually have a long list of videos to prepare. So let's move to question number 22 now. How do you account for transaction cost, financing fee, and miscellaneous expenses in a merger model? So in the old days, you used to capitalize these expenses and then amortize them. But with the new accounting rules introduced in the end of 2008, you are actually supposed to expense transactions and miscellaneous fees upfront, but capitalize the financing fee and amortize them over the life of the debt. And expense transaction fees comes out of retained earnings when you adjust the balance sheet, and while capitalizing financing fee appear as a new asset on the balance sheet as and the amortize at the amount and are these are actually amortized each year according to the tenure of the debt. So this question, what kind of cost are we talking about? So three kind of cost are there. There are transaction cost, there are financing cost, and there are miscellaneous. Miscellaneous cost mean they are actually mix of all the costs. So transaction cost actually this means that the cost of actually doing the deal. That's the transaction cost. So when a deal is being done, so there is actually a cost involved by with doing the deal also. There are a lot of lavish parties. You actually have to travel a lot. You actually have to bring in all the investors. That's much. I mean that kind of things. So now, do you actually have to hire an investment banker to do all the deals and all? So that's a transaction cost. And financing fees means the cost of getting the money to buy the other company. Uh, like bank fees or underwriting fees to raise the debt, to pay for the acquisition. And transaction cost includes those costs like investment bankers fee, lawyers fee, consultants fee, accounting and due diligence fees, and all the party and the lavish stuff, traveling and all, jet planes and all those traveling from here to there to put up all the picture. I mean, to put all the frames into into one picture. And miscellaneous expenses are those expenses which are other small one-time costs related to the merger, and it actually includes integration costs or advisory costs or filing fees and all. So those are miscellaneous costs. And the difference between expensing and capitalizing is that expensing means the cost is shown immediately on the income statement, and it will actually reduce your profits right now. But the capitalizing means that the cost is treated actually as an asset, and you spread the cost over several years. How it was used to be done in the old times was before 2008, actually, companies would often capitalize all these costs, transaction deal, legal fees, financing fees, etc. And they would treat them as long-term assets that provides benefit over time and amortize them each year. And this is actually followed in merger and acquisitions of oil and gas even today also, because it's a different thing, and we will discuss about this thing when we will do the oil and gas sector study. But what changed the new accounting rules uh, was these were started to treat differently. So expensing and capitalize. So only fewer of them were being expensed and few of them were being capitalized. So now what we do is the transaction and miscellaneous fees, the transaction and miscellaneous fees, like we expense them immediately. The financing fee, we capitalize and amortize it. So transaction fees we have discussed, like legal fees, investment bankers fees, accounting and due diligence fees, consultancy and advisory costs. We actually expense them immediately because these are mostly the fees. And capitalize the financing fee means that we the bank underwriting fee, loan arrangement fees, and legal fees for setting up the new debt. We actually capitalize them because these costs are linked to the debt which we have raised for financing the deal. So that those are actually considered as a part of those are actually capitalized along with the asset, and this actually affects the financial statements of both seller and the buyer. Uh, and in plain English, transaction and miscellaneous costs are treated as one-time cost. You record them right away, you expense them out. And financing fees and all the fees is related with raising the debt are uh, actually these are considered as these are capitalized in these fees go on the balance sheet. So you treat it like a loan setup cost, and you spread them over the years of the loan. So simply understand this thing that you are buying a house and you pay a real estate. You actually pay the real estate agent and the lawyer.